What's going on, everybody? Welcome back to the channel. If you're new, subscribe, all the good stuff. But in this one, we're going to be talking about how you can be a great dividend investor. We'll talk about why people choose to invest in dividend stocks, why I choose to invest in dividend stocks and dividend ETFs as well. We got a lot to go over in this video. So if you're new, subscribe, turn on post notifications so that you don't miss out on any future videos. Check out M1 Finance if you haven't already. You can get some free money. But let's go ahead and get straight into it. So first up, let's talk about why dividend stocks. Like, why would somebody invest in dividend stocks that are said to be boring compared to maybe going to invest in a penny stock that could 10x their money or whatever it might be? So first up, dividends make up a large percent of the total stock market returns. Like, there's study cases from 1960 to 2020. The amount of returns that the S&P 500 made from reinvested dividends was like 84%. Which is insane. And just getting dividends kind of is an outplay to inflation, but they do perform far better than the overall market in the long term because dividend paying stocks usually are going to be more established companies, and just overall they have better management. They provide value to shareholders directly by paying them cash dividends, which is pretty important. Third is the consistent passive income that dividends provide. So you might be in the market for income, and dividends are your best option for that. They're better against market crashes and bear markets. There's study cases from 2000 to 2010, what a lot of investors experienced a lost decade, which pretty simply is just a decade where you make no returns and you probably lose money. And that's what a lot of people had in 2000s. But dividend investors, even though it might not sound the best, it was the best that they could have provided, and they provided about a 1.8% annualized return. And the dividend snowball effect, and that simply is you buy, let's say for example, you buy $100 worth of stocks, then they pay you $2 in dividends, you reinvest those $2 in dividends, now you have $102 in dividend stocks, and the next time they'll pay you more. Maybe they pay you $3. Now you got 105, and the next time they maybe pay you 4. Now you got 109, and it continues to compound and add up. But here's kind of what I look in dividend stocks. We're going to go over 7.5 kind of different things. So stay tuned for all of these. But these are really important in my personal opinion. So first up is having good revenue and earnings growth expectations. Historical performance doesn't always equal past or future performance. So you want to make sure there's good expectations. And there's no really number that I like to see, like an expected profit margins increase or expected revenue or earnings increase, but a lot of investors do aim for 5 to 15%. And if a company's revenue and earnings growth is like an insane rate, like 100% year-over-year growth, just know that it's most likely not sustainable. And there's probably a really big factor as to why the numbers are like that. So keep that in mind. Some sustainable rates are between 5 to 15%. And here's just kind of a look at two different images. As we can see right here, here's one company. Expectations on earnings expect to go from $9.02 per share to $10.53 per share. That's a good number. But right here on the bottom, we have $4.66 in earnings per share, estimated to go down to $3.07 per share, which is not necessarily what you always want to see. Next up is the payout ratio, and this is really important, especially for dividend investors. So the payout ratio is the amount of earnings being paid out to shareholders in dividends. So that might sound a little complicated. Let me give you an example real quick. Let's say a company has a 70% payout ratio. What that would mean is, let's say they made $100 in profit. If they had a 70% payout ratio, that would mean they're paying out $70 in dividends to their shareholders, because $70 is 70% of their profits. So usually companies with a payout ratio of 70 to 80% are the ones that I kind of stay away from, unless they have some type of reason for me to believe that their dividend is still sustainable. But REITs, real estate investment trusts, those have higher pay ratios because by law they're required to pay 90% of their taxable income to shareholders. So those are an exception. But if a company does have a really high payout ratio, they're paying out a lot of their earnings to shareholders, it's usually not sustainable and an indication that management is not that good. So here's kind of some examples real quick. Here's a company with a 27% payout ratio, which is very sustainable and very good. But as you can see, they do have a lower yield of 0.72%, but I'd rather pay a low yield that's consistently going to get paid and probably grow rather than a company that has a 109% payout ratio, a high yield that's probably going to get cut either way. I mean, if you just look at these numbers, this company right here with a sustainable payout ratio has dividend growth of 17 years, meaning they've increased their dividend payments for the past 17 years. This company right here with a payout ratio of 109% has had it for 0 years because they had to cut their dividend because it was not sustainable. Next up is having an economic moat. What that means is your company that you're investing in, you want to make sure that they have something over their competition that makes them better. And you want your stocks to have a great long-term outlook and sustainability. And a company that is just there because it's there is not going to have a good long-term outlook. So let's take an example, Coca-Cola, their brand name and customer loyalty kind of gives them that economic moat. You might look and you might see if you went to the grocery store, you're probably willing to pay an extra dollar for a Coke rather than paying $1 less for some off-brand Coca-Cola remake, And that's an example of having a moat. And you want to make sure that these companies right here, it says economic moat wide. What that means? It means that they have a very good moat against their competition. Fourth, you want to make sure that a company's valuation is not crazy, having lower PE ratios. And what this simply means is you don't want to go buy a company that's incredibly overvalued. One of the biggest takeaways I've taken from the book, The Intelligent Investor, which I highly recommend you go get it if you haven't already. I'll leave a link in the description down below to it on Amazon. But this book, one of the main things I took away was kind of whenever they said you got to pay for things at fair values. Like, for example, they took Michael Jordan whenever he played for the Chicago Bulls. I think they said they were paying him like $34 million a year, and that was a great deal. They were getting incredible value for Michael Jordan for $34 million a year. But it would make no sense for them to be paying him like $500 million a year. It would honestly just not, the value to the cost would not pay out. So you want to make sure you're paying for companies at good value. And you kind of just want to compare, So here's two companies. You have a bank and then you have Microsoft. Two completely different companies. And Microsoft's PE was 37 while the bank's was 11. So the PE is the price to earnings ratio. And you kind of just want to go ahead and literally search into Google if you're trying to buy a bank. Average bank PE ratio. And you can find that. You can find that information. So you just want to go see how do they compare to their competitors. Fifth is the stock history and the future outlook. This one is not necessarily a huge factor because historical performance does not equal future performance. But is the stock uptrending and can it continue this? Is there a good outlook for it? Or is it plateauing? Is it staying flat? Is it going down? And what's the reasoning? An example of a stock that I'm going to use is AT&T. Pretty much this stock, like as you can see, I don't see any uptrend coming for it in the next few years. And I just don't see a reason why I would invest in it. The past 5 years, it's down 30.5%. And just because the stock is down doesn't mean it can't recover. But AT&T is just an example to look at. Sixth, let's talk about having strong cash flows. Your dividends are paid in cash. They're not paid in credit. So cash flows are very important for a company, especially whenever you're investing in one. I like to see free cash flow increasing, but a lot of investors do like to see about 5% increases in free cash flow, making sure that these companies are financially stable. So here's an example of a company with a really good increasing free cash flow. And here's a company with really bad free cash flow. It's in the negative. You don't like to see that. Seventh, and this is kind of the last stock tip that I look for, and that's going to be the analyst and institutional sentiment. It's something that I just personally like to look at. I like to see what other people are saying. What are the price targets on the stock? Are institutional investors, like the big banks, are they buying or selling? What are other sites giving them a fair value of? And don't let this be number one. Don't let this make you say, this is my catalyst, this is my opinion on why I'm buying a stock. Just because it has a high price target or a low price target means you buy or sell. So kind of example would be like a random stock is at $10, but has a price target of $20. Don't let that be your thesis for buying. Look more into it. There's so much more than just price targets. And here's some examples, Here is a Microsoft. From the price that this picture was taken, they had about 7.5% upside which I like to see. And the institutional activity was a lot of inflow, $104.09 billion in inflow, which is buying, and $65 billion in selling outflows. So it's a lot more buying pressure than selling pressure, which is usually a good thing to see. And literally, if you want to go find this information, this is marketbeat.com on the bottom, and this is tipranks.com at the top. Pretty simple to find. But eighth, and this is one that's very, very important, okay? It's being patient, envisioning the long term. So you got to remember that patience is a true virtue, and that in investing, especially dividend investing, you've got to be like very, very solid in being patient. It's not the easiest thing, like seeing people go out and seeing all these TikToks or YouTube videos about people making crazy options trades or day trades, I've done it myself. I've tried day trading. I've tried options trading. It was a great learning experience. I learned a ton, but I just don't think it's for me. And being patient really can benefit you in the long run. It's okay to go invest in things other than your dividend portfolio or your ETF portfolio, whatever it is, but you can't lose sight of it. You got to be consistent. If you have the capital and you say you're going to invest $1,000 a month in your portfolio, invest $1,000 a month in your portfolio. Don't make excuses, And here's kind of some Warren Buffett stuff. Here's a quote. The stock market is a device for transferring money from the impatient to the patient. And here's some more quotes, It's all about being patient. And Warren Buffett, legendary investor, we all know him. He is a key of being patient, And just kind of the final words, just to sum everything up, I'm just going to throw it up. You want to invest rather than spend. You don't want to be a yield chaser. You don't want to invest in stocks that just have a really high yield. You want to make sure that their payout ratio is sustainable. You want to invest in companies that have a really good future ahead of them. Past performance does not equal future performance, so make sure that they do have a good future ahead of them. Invest in what you know and understand, because you need to know what's going on with your companies. If something does go wrong, you need to understand everything about it. You want to aim for any dividend yield as long as it's sustainable. They say anything about 1% is pretty low. Around 3% is really good. And anything about 5% plus is high. But sustainability is the most important part, in my personal opinion. And you only want to buy companies that you have strong conviction in. You don't want to buy a company because your friend or your family member said, go buy this stock. Even if I buy a stock and you don't have a good feeling about it, don't just buy it for that. And last is know your investment time horizon. Younger investors usually have more time for growth, so it makes sense for them to invest in companies that are growing faster but maybe pay a lower dividend. And investors with lower time horizons usually aim for higher yields and lower growth for consistent income right now. But that's going to wrap it up for this video. Thank you for making it to the end of this one. Subscribe to the channel if you're new. Turn on post notifications so you don't miss out on any future videos. This is me up here in the top right. Maybe we'll get a facial reveal coming soon. Who knows? Leave a comment below what you think about all this information. I always love to hear your input, all that good stuff. Check out M1 Finance if you haven't already. Go check out my Udemy courses. They're going to be on discount, really cheap for incredible value. And I will see you at the next video.